most of you have seen the recent statement I put out a little while ago, and I'm glad you got it. But I feel that way. I really do feel that way. Let them get their land back.
Yep.
So we'll see how it all works out.
President Trump there referring to his Truth Social post that represents an extraordinary shift in his position on the war between Russia and Ukraine. He now thinks Ukraine can win back all the territory lost to Moscow, calling Russia's military a paper tiger. Live from Singapore, this is Inside with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Fed Chair Powell says the outlook for the labor market and inflation face risks, calling it a challenging situation and giving no indication whether he'll support a rate cut next month. ARK Invest chief futurist Winton will be joining us with his outlook for the AI rally, the crypto crash, and ARK's return to Chinese stocks after a 4-year gap. And Super Typhoon Ragasa lashing Hong Kong hard, threatening widespread damage after killing at least 17 people in Taiwan and the Philippines. We speak exclusively with the CEO of the Philippines' largest airline, Cebu Pacific, about how the emergency is affecting their flight plans. Here's a quick check on the markets. Asian stocks falling for the first time in 3 days on the Fed chair's mixed signals. Brent, by the way, extending its biggest gain in a week as Trump ramped up his rhetoric against Russia, and traders also watching for supply disruptions from Russia after it mulled restrictions on diesel exports for some companies as well. In terms of the laggards here in Asia, the Kospi down more than 1%. We have the CSI extending its gains, currently higher by 0.2%. Now, our top story today, President Trump striking a more optimistic tone on Ukraine's chances of winning the war. Trump now says that with the support of the European Union, he believes Kyiv is positioned to fight back and reclaim territory taken by Russia. The comments follow his meeting with Ukrainian President Volodymyr Zelensky on the sidelines of the United Nations General Assembly in New York. Trump also says NATO nations should shoot down Russian aircraft that breached their airspace following several incursions that have alarmed Moscow's neighbors. Let's get more on what looks like an extraordinary President Trump's change of stance on the Ukraine crisis with Wesley Clark, former NATO Supreme Allied Commander in Europe. General, good to have you with us. Is there any basis for the turnaround in President Trump's stance on Ukraine?
I think the president has realized that Mr. Putin just really doesn't want peace. He wants Ukraine. And that as long as he thinks he's winning, and as long as the president holds out benefits for him, then he's going to continue. So I think the president has recognized that he's got to shift tactics to deal with Mr. Putin. Got to convince Mr. Putin he's not going to win, and he'd best take a peace deal as soon as possible. And I think that's behind the rhetoric that the president has made.
You called it a rhetoric. Why?
I think it's a very bold statement, saying that we're going to shoot down Russian aircraft or systems that penetrate NATO airspace, as well as the assertion that Ukraine could take back all its territory. Now, it's got to be backed up, and that backup requires lots of military assistance. Sanctions are fine, but the sanctions take a while to work. Sure, Europe shouldn't be buying Russian oil and gas. Europe has plans to deal with that, but they're slow, and the impact on the Russian economy will be marginal at first. And right now, there is a Russian offensive underway. Ukraine needs military assistance. The United States and our NATO allies should be providing it. So the statements are good, got to be backed up by action.
And yet, President Trump says Ukraine is in a position already to fight Russia. What else needs to happen for that to actually materialize?
I think the attacks that Ukraine is making on Russian the petrochemical industry, the refineries, the pipelines, and so forth, are really having an impact on Russia. That is a strategic infrastructure set of targets, and Ukraine is showing the ability to go after them. In addition, Ukraine has developed some other systems, some long-range drones, something like a long-range cruise missile, a long-range semi-autonomous underwater vehicle that can go into harbors and wreck harbors and bridges and things. So the technology race is in Ukraine's favor right now. The Ukrainian soldiers are doing an amazing job of holding tight on the Donbass front and resisting Russian movements in the northeast and in the south. So I think when you look at it from the president's perspective and you listen to the people who've been there, looked at the front lines, talked to the Ukrainian soldiers, you find this incredible resolve on the part of Ukraine to hold on. They're not about to give up. And I think the president now recognizes this.
General Clark, it is interesting that Trump said Ukraine can regain lost territory. But what's interesting is that he said it can regain even more than that. What do you think he means by that?
Well, I think he means that Ukraine could regain its sovereign boundaries, including Crimea.
How are you reading Trump's statement when it comes to NATO? He suggested that NATO should shoot down Russian jets which breach NATO airspace.
Well, NATO is us as well as our European allies. And all those NATO assets that are in the air defense system right now are under the control of the U.S. commander, the strategic commander in Europe, who is an American four-star general. So it's not just Europe, it's the United States engaged in this. And I think he recognizes that Putin is applying some salami slicing tactics. He moves forward, he probes, he pushes, he checks to see if there's a reaction. If there isn't, he pushes again and goes a little bit further. And there is a risk to European democracies because it's very hard for democratic leaders to blow the whistle and say, well, it hasn't happened yet, but it could happen again. So I think the strong expression that President Trump made really enables European leaders to rally their publics and understand that the use of lethal force to down Russian aircraft and other assets that penetrate NATO boundaries is authorized as well as necessary at this point.
The thing is, you can't just shoot down a Russian plane. In terms of rules of engagement, the caveats that are required for that to take place, could you take us through what's needed?
You would have to publish rules of engagement. You'd need to tell Russia very clearly, you come over the boundary, you'll be considered hostile, and you will be engaged and destroyed. So you have to be very clear about that. You have to brief your pilots on it. And you have to make sure everybody understands what the boundaries are. But I will tell you this, that today, with global positioning system, with inertial guidance, with modern communications, there's no excuse for the kinds of fuzzy boundaries and lack of understanding that there might have been even 25 years ago when I was NATO commander. It's very clear where the borders are. They're electronically marked. They're visible in airport cockpits, including Russian airplane cockpits. And so it's much easier to justify a penetration of NATO airspace as an intentional penetration, not an accidental penetration.
It is well and good that President Trump is suggesting that NATO shoots down Russian planes. He has not committed that the U.S. could be involved, could assist in such a scenario. How do you find that response?
I think the U.S. commander in charge of the Eastern Resolve mission that NATO put together after the incursions in Polish airspace, the United States is involved. Now, which U.S. aircraft are where? That's a matter for military command. But the whole point of NATO is that we work together as allies. There should be no distinction between a Polish aircraft, a German aircraft, an Italian aircraft, a Dutch aircraft, and an American aircraft. They're all under NATO command.
General Clark, I'm just wondering, from the perspective of the smaller NATO nations, how do you think they're interpreting Trump's comments? Is it a commitment? Is it a bluff? Is it a threat? I mean, this is a president who's gone back on his words.
This is true, and this is a factor in the interpretation of what the president has just said. But the United States does have a legal commitment under NATO Article 5 to consider an attack on one as an attack on all and take the appropriate action, which could include military force. So what the president has said is reinforcing of a robust interpretation of NATO Article 5. I think that's a welcome reassurance to all of NATO's members, and especially those on the eastern flank.
General Clark, always a pleasure to have your perspective on the show. Wesley Clark, former NATO Supreme Allied Commander in Europe, joining us on Insight. Still ahead this hour, ARK Invest's chief futurist joins us to discuss where they're seeing opportunities in AI, chips, and cryptocurrencies. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside, and we're seeing a rally in Alibaba stocks up by as much as 7%, taking its gain for the year to about 110%. What a run. We know that Cathy Wood's funds has reopened positions in China for the first time in 4 years with Alibaba and also Baidu. That's as the stock rallied to a multi-year high and optimism over the Chinese firm's push in AI. Remember that companies like Alibaba have been spending billions of dollars in its push in AI as well as cloud. Let's get perspective from Brett Winton, chief futurist at ARK Invest, a global asset manager specializing in thematic investing in disrupting innovation. Brett, good to have you with us. What a run. But some say that, you know what, if you get in now, there are losses to be made simply because the upside is limited.
And AI, which is accelerating, globally in a profound way, I think that we're actually in the early stages of what's probably going to be a multi-business cycle expansion. If you look at AI chatbots, they're in their basically 15-ish% penetration rate of overall global smartphones. That's where we were in internet penetration of PCs in 1995. In 1995, AOL was just sending out its first CD. Yahoo was just accepting its first VC dollars. Cisco was trading at $2 a share. And we think that's the approximate place we are in this cycle. And so we think that, China and US technology companies know that they have to get in front of AI in order to thrive over the course of this business cycle. And we think investors do as well.
So, Brett, the rally has just only begun. If you had to put a number to it, how much more upside do you think? Maybe in a period of 12 months.
Well, I mean, I can't tell you over 12 months, but I can say that we think approximately $90 trillion in enterprise value is going to be attributable to artificial intelligence software, hardware, and infrastructure as a service by 2030. To give you a sense of the scale, that is roughly the size of the global equity market. The global equity market is around $120 trillion as of the end of 2024. So we think the creation of enterprise value here is going to be profound, really the likes of which we've never seen.
Brett, I know the optimism. I hear it time and time again on this show. But what if one day you wake up and then you realize that, you know what, I'm not getting the returns from the billions and billions of dollars I'm investing in AI? I mean, how do you hedge against that risk, and how are you assessing that risk happening?
Well, we invest not just in AI, but in all 5 innovation platforms that we're invested in. So energy storage, autonomous vehicles, multi-omics, where we're seeing deeper value plays than we've ever seen, at least across the course of my career, and public blockchain. So AI is working right now, and we think it's going to continue to. But public blockchains, Bitcoin, and other cryptocurrencies are a totally different set of orthogonal bets. And so across both our venture portfolios and our actively managed ETFs, we think that having a mix of innovation is important to winning over the course of the business cycle.
So Baba marks your first inroad into China for the first time in 4 years. Might you be looking at others? Should you be looking at other, I guess, tech plays that might bring you the kind of returns you're looking for?
I mean, I think that China recognizes that AI is the future, just like the U.S. does, and China is likely to unleash kind of its technology companies after feeling threatened by them for a while. We've seen the advances in open source AI models coming out of China, and think there's a lot of innovation there in both the software and hardware space. And so given the relatively still depressed valuations, price to sales, Baba is less than 3 times. We think it's actually great value here. And we think that the entire globe is going to benefit from the acceleration in AI, which is going to create a boon for humanity.
Brett, I also want to touch on cryptocurrencies. We know that ARK is one of the strongest advocates of cryptos out there. It's been a tough week for crypto investors this week, raising about, $1.7 billion already so far. What's your take on what's happening in the crypto space this week?
I think if you're paying attention week to week, your time horizon is the wrong time horizon. We think that there's both a monetary revolution going on, which is stable coins and Bitcoin really changing the way that money works and digitizing money. And there's the smart contracting revolution, which is changing the way financial ecosystems work. Whether it be Coinbase that is clearly posing a competitive threat to traditional banks, or Robinhood, which is leaning into crypto to displace existing brokerages. We think that the modern age is going to be built on cryptocurrencies, and the AI economy is going to thrive on the basis of a true digital money.
The thing is, some say data is murky. 1.7 bill could be just the tip of the iceberg, because if you take a look at companies like Binance, for instance, they don't really tell you the full scale of the liquidation that might be happening. There is a huge risk you're not getting a clear picture.
I think cryptocurrency and innovation by its very nature is volatile. From our perspective, it's clear that cryptocurrencies are taking share from traditional currencies, and they will continue to through the end of the decade. And, tokenization of financial assets is just beginning. We think it's on the order of penetration comparable to the dial-up internet. And so even a 5% penetration of financial assets with tokenization would lead to trillions of dollars in value accruing to the underlying protocols.
We know that you're a futurist, so we're going to get your views on that when it comes to, positioning for this, for a position several years from now. What should we be looking at in, the crypto space, in the AI space?
Sure. Probably the longest term portfolio we have is our venture fund. And there you look at the top positions. We have the likes of SpaceX, OpenAI, xAI, Anthropic. We think we will be a globally interconnected world with low Earth orbit satellite networks. We'll hopefully be launching rockets towards Mars. And, AI chatbots are going to go from the high hundreds of millions of active users today to, we think, 5 billion before 2030. And so this is going to be a transformation in how we work with computers and all of our digital devices.
Well, the thing is, we keep talking about the same old companies, right, which have had such a run-up. Any companies we should be looking at that we're not paying attention to?
Well, a tremendous company that I use a lot of, internally, and that we're also invested in the venture fund is a company called Replit. It allows anybody in the world to code using AI, and you can launch an app easily. The pitch is that we've gone from barely anybody knowing how to code to everybody in the world being able to code, and Replit's the platform on which it will happen. We think it's a great exposure to AI that lots of people are really having fun playing with.
What's the biggest risk for your projections there, Brett?
Well, regulation can always get in the way of innovation. Luckily, the innovations that we invest in are portable. They can go across borders. And so there is pressure put on companies or on policies that are imposing onerous regulation on technology. We think autonomous vehicles is a good example where people in New York are not likely to tolerate very long the fact that people in Texas are going to be able to ride around in Tesla robotaxis for $1 a mile while they're being forced to schlep themselves and still waste their big, beautiful brains by piloting mechanical vehicles. And so we think that as long as the deregulatory thrust that's happening now continues, it's open season for innovation and innovation investors.
And in terms of the non-AI, non-chip space, what's exciting?
Well, we're finally curing diseases. For a long time, medicine has only been something that you can give to somebody that provides ongoing treatment and really manages symptoms. There's a cure for sickle cell disease that's in the market today that CRISPR Therapeutics is selling. And there's a number of candidate cures that we think are going to enter the market and really transform the lives of people that have rare diseases. What's interesting about it is we don't think that Wall Street understands that cures aren't bad for business. They're actually quite good because you get to recognize all the lifetime of revenue from the patient up front. And so you avoid the competitive intensity of the patent cliffs that would otherwise pinch you. So we think the multi-omics space is going to be accelerated across the board by AI, and it's still trading at really depressed valuations.
Interesting that you talk about how Wall Street isn't understanding some of these trends. What is the one idea, one trade that would outsmart Wall Street?
Well, you can see in our publicly traded portfolios, Tesla's our largest position. And I really think Wall Street doesn't understand it. It doesn't understand it because they don't believe the robotaxi business model will be as lucrative as it's obvious to us it will be. Tesla, in our view, will go from selling a vehicle and making a handful of thousands of dollars in operating profit on the one time they sell it to having that vehicle be able to generate, we think, tens of thousands of dollars in operating profit as a robotaxi every year that it's in service. So they go from just the incremental sale getting one-time operating profit to every vehicle in fleet potentially generating, not an order of magnitude, but a half order of magnitude more operating profit every year. It's clearly not priced as if that's reality, right, but we think it's the reality to come.
Brad, it's hard to talk about investing without bringing the Fed in, right? Final question. Is the Fed and, the easing cycle that's coming up influencing the way you deploy your funds?
Well, I do think we're on the start of a probably meaningful easing cycle. Our job is to invest in innovation. So one of the things that we've done throughout our more than decade of existence is we've always stayed fully invested in innovation. And we think it's important that clients maintain a meaningful exposure to innovation as well. Regardless of what the Fed does, this cycle is going to be a cycle that we believe is driven by technology. And if you don't have meaningful innovation exposure, the disruptive innovation may disrupt your existing portfolio.
Can't miss that optimism, Brad. Brad Winton, Chief Futurist at ARK Invest. Thank you so much for joining us. Still to come, Cebu Pacific CEO will be joining us to discuss the airline's outlook target for 15% growth this year. Keep it here with us. This is Bloomberg. Welcome back. You're watching Inside, and we're showing you live pictures out of Hong Kong after the super typhoon Ragasa lashed the city with tree-snapping winds and torrential rain. It could be the most damaging typhoon to hit the financial hub in 7 years. Let's bring in Bloomberg's Danny Lee. And Danny, we know that it's been quite a scene in Hong Kong. Take us through the kind of destruction that you've seen so far.
Well, for residents overnight, the full force of Super Typhoon Ragasa hit Hong Kong and southern China. We've heard, howling winds, which made it so difficult to sleep. Tall buildings, residential buildings swaying from side to side, the thuds of the wind. So, it really summed up the full arrival of this storm, one of the worst storms to hit the world this year. And it got as close to as 100 kilometers to the Asian financial hub a few hours ago. And it's moving southwest towards western Guangdong province, where it will make landfall later on this afternoon. But as for the destruction in Hong Kong, it's still hard to tell at the moment. There has been a lot of preparation done in advance, which could minimize things. We have heard a lot of reports about fallen trees, not too many in the way of injuries. So far, we don't see any obvious damage as well. But, things like the stock market in Hong Kong is still open, although many people are working from home today to try and keep safe.
You reported yesterday that the likes of Cathay suspending flights for about 36 hours. Any clarity on whether they will resume operations come Thursday?
Yeah, the airlines are working to the assumption and the guidance of authorities that they can safely resume operations from as early as 6 a.m. on Thursday. It will take some time for the recovery to spool up because Cathay, like with many local airlines in particular, have sent a lot of their aircraft assets away from Hong Kong for safety. So once they get back, it will take some time, and particularly over a day or two and even longer, given the volumes of passengers displaced, to get back and running into normality. Of course, for Cathay, cancelling 500 flights, and obviously today it's its birthday, it's celebrating its 79th birthday. So for them, it's a bit of a difficult one, given the disruption and the storm it's facing.
Happy birthday to Cathay there. Danny, stick around because we have Cebu Pacific CEO Mike Szucs joining us now with his take on the typhoon's impact on flights and the airline sector. Mike, good to have you with us. For an airline CEO, what goes through your mind when you take a look at what's happening in Hong Kong, the kind of suspension that's being done by the likes of Cathay, 36 hours?
Yeah, no, it's very difficult. And I think the guidance that Hong Kong have come out with and giving that broad guidance to everyone, both airlines and indeed passengers, around the 36-hour sort of stoppage, I think is very helpful, frankly. I mean, you can't be exact on these things, but it's giving out the strong message to say, really, don't travel unless you have to. Things aren't going to be moving for about 36 hours. And there'll be some finessing around the edges in terms of, the exact sort of when it restarts and how it restarts. But I think it was the right thing to do. But if you look at Cebu Pacific, here we are in the Philippines. I mean, we are used to being right in the thick of it. So, of course, that typhoon passed at the northern tip of our islands just before it went into Hong Kong. So we're right in typhoon season. This is something that we have to get used to. And if anything, of course, I think, whether it's global warming or whatever it might be, but we are looking at more extremes in the weather, and it's something that airlines have to face. And the operational teams, the customer-facing teams have to get very adept at dealing with this level of disruption. So it is part and parcel of airline business, and particularly in this part of the world.
Mike, is it too early to talk about the kind of losses that airlines might go through? I know that, those flights will resume on Thursday. At least it's planned to resume on Thursday, but we don't quite know how quickly things can happen.
Well, I think Cathay will have effectively lost a day's worth of revenue at least, plus there'll be the costs of the disruption too. They'll have had aircraft and crew displaced. So it will undoubtedly be a cost, but an airline the size of Cathay should have the resources to accommodate that. But, hopefully these things are really sort of 1-2 days maximum, and you just have to build them into your thinking when you're planning for your business, when you're budgeting. You have to have contingency in your resources, one, to be able to deal with it, but also financially to be able to manage it. And someone with Cathay's resources should be able to do that, no problem.
Yeah, Mike, we had the typhoon affect the Philippines and also Taiwan and southern China. But how are you thinking long-term about climate change, particularly in the Philippines, as these storms come with more frequency and they intensify? How are you thinking about the impact on your operations and how you minimize the disruption on operations and profitability?
Well, first of all, I don't think there's anything we can do other than, we're all working on our own sustainability paths, etc., to make sure that we all make our own contribution to climate change and to minimise the effects. But specifically, as an airline, how do we handle these storms, these extremes of weather when they come through? Is you have to build in the procedures, you have to invest in your people, the technology, the customer-facing people especially, so that you can manage these situations very proactively. As I say, we have got better over the years, in part because we've invested, but also we've got lots of practice. If there is a part of the world that is right in the teeth of this in terms of typhoons, volcanoes, earthquakes, you name it, the Philippines probably is it. So we probably have as much practice as anyone in terms of dealing with these levels of disruption. So we've got a number of protocols that we go through ahead of time. So in anticipation of any weather events, obviously things like volcanoes and earthquakes less predictable, of course. But typhoons, we can see them forming. We know that there's another system forming at the moment, not as strong, but of course we've got a southwest monsoon at the moment, which should lead to some further problems. So a lot of rain is coming through, but certainly we're adapting our protocols and we're getting better and better, and partly through practice, but a lot of it's through investment in technology and people.
Airlines are grappling with other issues as well. Supply chain front and center has been a huge issue for airlines for a while now. Could you just take us to where it stands right now? What is the situation at this point in time?
Yeah, well, I know it kind of sounds odd. In the sense that, we're the one industry probably that still talks about the tail effects of COVID and how that's still affecting us. And you really have to go back to what COVID did. For the airline industry, it was almost existential as to, was the airline industry going to survive during those times in COVID? And so decisions were made. It might be that a number of experienced people in the supply chain, in manufacturers, for example, in suppliers, were laid off. And these were very experienced people, and they've had trouble getting those experienced people back. Often they haven't come back. And you have to replace those with younger people who've got to learn their trade. So whether it's the OEMs themselves, the big boys like the Airbuses or the Boeings or the engine manufacturers, or it's the tier 2, tier 3 suppliers, it's trouble for them getting the people back. And that's having a massive impact on the availability of spares, and it's having a massive impact on the manufacturers as well in terms of their ability to deliver to the schedules that they have contracted to. And on top of that, you get some specific issues as well on, say, engines, where, as you know, we're a GTF operator. And so we currently have 16 aircraft on the ground, long-term AOGs, because we haven't got engines for those. These are new Airbus Neos, but the shortage of engines on those means that those aircraft are on the ground. So it is having a very large effect on us. And in terms of what does it mean to the business, or how do you run the business, in all the years that I've been doing this, and for all of us, none of us have encountered this situation where you have so much variability or so much uncertainty in your available fleet. And so I remember back in the day, we used to do fleet planning. If I go back all those years, and it's many decades ago, we might do fleet planning a couple of times a year and then review it once a month. We now review our fleet plan and our outlook 3 times a week. Because what we clearly want to do is to make sure we're going to have the available fleet to serve the inventory, or to serve the seats and to serve the flights that we've got on sale, and not just to serve it, but also to make sure that we've got effective levels of contingency in terms of standby aircraft and engines available. So that's an ongoing task, and it makes life extremely difficult, but it's one that we have to do. Again, if we go back when we immediately emerged from COVID, we were all new to this, and it all came as a bit of a surprise. Now I think we've all got much better.
Mike.
We've added in more contingency, and we're better at managing it.
Yeah, Mike, it does sound like you're on a constant war footing. Now, let's look at the short-term outlook. You've said for 2025, the airline wants to grow by 15%. Where are you now relative to hitting that target, given the supply chain constraints you face and the short-term volatility in knowing what aircraft are available and how you can grow?
Yeah, well, look, let me context it a little bit before I very much will answer the question. But I think, we wanted to grow faster than normal this year, or grow more aggressively. And if you asked me a year ago, we were thinking we could get as high as about 25% based on the projections we were getting. And we could see that it was already in the first half we weren't going to get there. But in the first half, we actually grew about 21% in terms of seats, and actually great that we grew like that, because we were able to fill them too. So there was clearly the demand, and our strategic push for a more aggressive growth profile was the correct one. But certainly the AOG situation on the long-term AOGs, that 16 number is higher than we anticipated. So in the second half, we expect growth to moderate. In fact, if I look at Q3 will probably be in the low single digits in terms of growth on a VOY basis. But then when we get into Q4, it will be in the low teens. So over the year basis, I would say we're going to be somewhere within the range of 13 to 15%. Still a very healthy growth rate on a full year basis, not where we'd like to be. But I think what you've heard there is Q3, we're certainly going to moderate the growth quite a lot, because that's the weakest period of the year, and we want to be able to maintain our capability to fly the maximum amount of capacity when we get into Q4, which obviously has the Christmas peak.
Mike, if you take a look at the macro environment, we have rates trending lower. But at the same time, we're today looking at higher oil. How are you factoring all of that when you take a look at your earnings outlook?
Well, look, if I look at the overall sort of picture, I think from a macro point of view, the Philippines has seen quite a stable environment. I think first of all, the peso has been very stable, which is good for us. About 65% of our costs will be dollar denominated. Of course, that includes fuel. And fuel, if anything, is still, it spiked up a little bit. It's still off from where it was last year. So this is good from a macro point. But the offset to some of those is some of the additional costs, those burdens that we have. For example, carrying all these sort of idle assets, if I can call them that, all these 16 AOG aircraft, plus the a large number of spare engines that I have. I have a lot of idle assets. Now that's a cost burden to us. It's a burden on our balance sheet. Plus we've seen inevitable costs on things, supply chain, particularly around the maintenance, and we've seen a spike in airport costs as well this year. So, but outside of that, we're controlling our costs very well. So it's a bit of a wash on an overall net basis. And so if I was looking at, where we are in terms of our progression, in terms of our earnings, last year we came in, EBITDA around 24-25% margins, not where we want to be. We want to get back to where we were consistently above, 30% plus in the years leading up to COVID. We would anticipate that we'll improve our margins from last year by 1 or 2 points. Not yet back to pre-COVID levels, but certainly on a path over the next couple of years. I think we'll really see the improvement when we can really free up all those idle assets that sit on our balance sheet. Now, depending on your point of view and the projections of the industry, Pratt & Whitney especially, I would think it's really going to be about 2020, late 27, early 2028, when we will see the situation on the Pratt & Whitney engine really fully resolved and we can get all those assets flying.
Mike, very briefly, what is your outlook for 2026? How much you anticipate growing, and also just some of the trends we are seeing in the industry, particularly this premiumization of low-cost carriers?
Yeah, well, we grew very fast this last sort of 18 months, consciously faster than we would normally grow. And it's because we saw the opportunity to do so. I think certainly the Philippine AirAsia is considerably smaller than it was pre-pandemic, and PAL has only really just resumed its growth. We saw the strength in the economy here, gave us the opportunity to grow more quickly. So we did that. We anticipate growth next year. Well, it's quite a broad window, but we certainly anticipate or hope it's going to be maybe in the 5 to maybe 15%. It's a wide window at the moment as we try and understand exactly the situation on the GTF engine. If I turn to premiumization, I think there's a lot of talk around that, particularly in the US. I think it's very much a US phenomena. I think United, in particular, Delta also, are really sort of attacking the low-cost carriers, I think very much fueled by their buoyant loyalty programs, which are subsidizing the attack, plus the long-haul premium. But if you step outside of the US, I'm still yet to see Michael O'Leary change his mind in terms of what he's doing. And if we look back over the last 25 years, that's been the best airline in the world by far. So we think here in the Philippines we'll stick to what we're doing.
Mike, thank you so much for joining us. Great perspective there. Cebu Pacific CEO Mike Szucs and our own Asia transport reporter Denny Lee. Well, still to come on the show, why India is pressing the US for more room for IT workers in the latest round of trade talks. Details just ahead. This is Bloomberg. Welcome back to Inside. Indian officials are set to ask U.S. trade negotiators to ease access for thousands of skilled workers days after President Trump's abrupt announcement on restricting H-1B visas. Let's bring in Bloomberg's Shruti Srivastava in New Delhi. Shruti, why is the H-1B issue so critical for India?
So, Haslinda, Indian negotiators are going to raise the issue of, not just H-1B visa, but the broader mobility of skilled Indian professionals from the country to the US. Now, services is a very crucial sector for India. Almost half of the total goods and services exports, were services in the last fiscal year. And it comprises some 50% of the GDP. So services is very critical, and movement of skilled professionals is one of the main way through which India exports services. So services sector is critical, and the initial plan was, that in the US will first discuss the goods part of it, and then we'll move on to the services aspect. However, this crackdown on immigration by the Trump administration, it has pushed the Indian negotiators to bring services into the trade talks now. Its importance, its importance is given by the fact that almost 70% of the visas which are issued to Indian nationals.
The thing is, it will complicate trade talks further, no? I mean, things were already quite challenging before this.
Yeah, definitely. It's going to certainly complicate the trade talks. The trade talks are already complicated by Trump's repeated assertions and the penalizing tariffs of 50% that the Trump administration slapped on India. Trump has been blasting India for its purchase of Russian oil. And now the crackdown on immigration, it further pushes India into a corner and complicates the trade talks. India's trade negotiator, led by its Commerce Minister Piyush Goyal, they are in Washington this week for carrying forward the trade discussions. Let's see what comes out of the meeting.
Let's see. Shruti, thank you. Bloomberg's India trade and economy reporter Shruti Srivastava there. Let's do a check on Indian markets. Been trading for about 5 minutes now. We know that Indian tech stocks have had difficult time indeed. In fact, they've lost about $10 billion in terms of market value. We're seeing those benchmarks currently down pretty much across the board. The Sensex down 0.3%. The Indian rupee flat 88.7450 as we speak versus the USD. Now, the Nifty and Sensex both down for the last 3 days, by the way. President Trump's plan on higher visa fees is just one more reason to look for outperformance from India's domestically exposed stocks, which are less vulnerable to America's first agenda. For more on this, let's bring in senior Asia equities reporter Abhishek Bishnoi. You can only imagine they're re-looking at the strategy right now.
Absolutely. And, what that communicates is that anybody who is bullish on India should look at very locally oriented stocks rather than export plays. This H-1B visa thing was not something that wasn't expected, but the, size and scope of it is pretty surprising. And it just puts the whole debate around whether valuations have become decent enough for foreign investors to come in again for India's rally to expand from here on the back burner. So, the argument that valuations are in sync with the long-term average goes out of the window. The argument that earnings have started seeing green shoots again goes out of the window, because now this overhang creates sort of a headwind for valuations in particular, not just earnings from the tech industry side, but even for valuation. So now, markets are trading at about 20 odd times. So, there can be easily a scenario where they derate to like 18 odd times. It becomes a consolidation phase. It still remains a very much structural bullish market, but this remains a very consolidation sort of phase for the next 6 to 12 months. But, things may also change. You never know, with Trump. If he agrees on lowering the tariffs, then, that sort of cancels out things that he has done on immigration's front.
So given what you have said, are there attractive players, attractive sectors right now which investors are looking at more closely than before?
Absolutely. We talked to a bunch of funds, and one of the funds, Allspring, was saying that they're going long on domestic cyclicals as they cut their underweight on India. Now, domestic cyclicals for India, it's a very rural market versus, the tech-oriented markets of China, Korea, Taiwan. And obviously, banks make the bulk of it. So banks would be the biggest players. In fact, there are many market participants out there, Haslinda, who have done the studies and have been marketing this idea for a year or something, that banks' profitability is actually going to overtake the profitability of something like a TCS. So you'll see these private banks becoming the prime bet here for those who are bullish on India. And then, of course, you have consumers and consumer discretionary, autos, so many other things. But primarily, this would be a very banks-led market because credit growth would still go higher. NIM would not be as big of a story, even if RBI is, eases in line with Fed.
Well, the thing is, there are numbers out there, right? They say like tech companies, like of TCS, may be impacted 6 to 7% in terms of their earnings margins. And does that necessarily mean they're not attractive anymore?
No, they aren't not attractive for the long term. But look, it is a business, and you have to perform. And the condition is that you will have H-1B visa fee. So you'll have to find ways and means to counter that. And how would that happen? A lot of sell-side analysts have been saying that these kind of projects would move onshore. Companies would start acquiring companies which already have talent in the US. So they'll try to manage it. But as they manage it, margins would succumb. There would be pressure. That would be the reality for the next few quarters. So naturally, why to buy something where there is a headwind? Why not buy something which is actually tied to the growth of an economy which is growing at the fastest pace among all the major economies? And that's what domestic cyclicals or banks are.
Time to reassess, look at valuations. Abhishek, thank you so much for that. Bloomberg Senior Asia Equities reporter Abhishek Vishnoi there. Now, before we go, here's a look at tomorrow's show. Market analysis from BNP Paribas Wealth Management's Shefali Sachdev. We'll discuss investment strategies in FX and bonds as traders weigh mixed messaging from central bank officials. For now, that is it for Insight. Horizons Middle East and Africa is next. Do keep it here with us. This is Bloomberg.